All right, here we go. Stanislaus and San Joaquin real estate market update for the end of Q1 of 2023. You read that email right. 7% increases in pricing, medium home price in the first quarter of 2023. Talk about a just volatile market. It's very bipolar, it feels like. The rates go up, it squeezes affordability. Sellers decide to strike, buyers decide to stand back. As soon as you see a bit of the break in the rate, you see buyers come back into the market, really showing the strength of the demand that buyers have. There's a high demand because they're just being pressured with some of the rent increases and the higher cost of housing. Even though they want to get into housing, there's just not enough inventory. And as soon as you get a little break of that rate, you see that surge of inventory. Something like the Dream for All program that just came out, which is just about the funds, $300 million in California, that was done with a partnership with California and some of the homeowners or future homeowners where they're sharing equity. It was an amazing program, but it quickly came and it's quickly going to go away, which you're starting to see the pending sales come up. But a lot of the increases in prices are based on the price in rate reductions from the beginning of the year, which then became pending sales in 30 days, became closings, which we saw right now. So let's take a look to see what the trends look like in both counties. I'm going to try to shoot this all in one video. Let's start with San Joaquin or Stanislaus County first. Here is the actual trends for Stanislaus County, and also very similar to what it looks like in San Joaquin. So rate goes up here. As soon as the rate goes up, that means that buyers just seize their activity because affordability just gets away from them. The debate over price over terms, terms are in most cases more important than pricing. Buyers do not buy a property based on purchase price. They pay off of monthly mortgage obligation. And when you see a rate like this go up, you start seeing this pending sales go down, and then you'll see the transaction count go down as well. You see some seller strike here saying, look, I'm just not going to sell my property. Inventory has been going down very consistently, remained relatively flat, slightly lower month over month. But as you saw this rate come back down here to low sixes, the activity of pending sales shot right up. And you saw the same thing here in, this is San Joaquin County. As soon as the rate went down, inventory continued to go down, but the pending sales went up, transaction counts went up by 25% more pending sales, and 14% more pending sales, 25% more solds. In Stanislaus County, you were at 25% more sales. 15.6% more pendings. Definitely more activity. The low sixes is something that really stimulated the market. Again, pressure of some of these tenants that really want to become homeowners and lock in their lifestyle. Low sixes was enough for them to jump back in. Again, not seeing this big surge of inventory like we're seeing, supply and demand. There's not a lot of supply. There's still very high demand, but whenever you crush affordability, you just have almost like a lose-lose-lose situation. Even though we saw prices go up 7% in the first quarter, we're still down from the peak about 7%. You'll see that in one of the next slides. So even though sellers are getting slightly less than they were getting at the peak, buyers are still paying 20% more, or in some cases a little more, in their monthly mortgage obligation. And then yet there's less transactions going on in the real estate industry. So agents, lenders, appraisers, inspectors, title companies, and everything, the economy around the real estate industry does get affected. So do sellers and so do buyers, right? So it's not a situation where there's really no winner when it comes down to the current market activity. Here's Fed reports. This is where the rate is, where it peaked up at 7, and this is kind of where it's came down a bit. We're hoping that by the end of the second quarter, it gets down into the mid 5s again, stimulating the market a bit more, hopefully getting some sellers to put their homes on the market, and again, transactions to tick back up. So days on the market dropped down to 42 days on average now, compared to where it was at the peak at 58. This is a number to look at, at the market where activity was really high, rates were low. Homes are selling for 1 or 2% over asking price. Right now, they're selling about 2% under, which means that sellers are getting more realistic on their price. Where 3-4 months ago, they were selling at 5% under. A lot of the reductions initially were sellers' expectations. Now sellers are expecting a little more challenging market because they're starting to understand affordability destruction and what's happening when the buyer's payment is 20% more because the rate went from 3 to 7% or 6.5% or 6.3. So that's what it looks like in Stanislaus County. San Joaquin County, very similar, 96%, recovering a bit from the low of 93. Days on the market creeping down as well. Even though it's 50 or 40 days on the market, it does not feel that way from conversations with the team. Homes that are priced well, our average days on the market is under 30. 30 days on the market usually is taking a slight reduction. Of a property's priced well, it's selling within a matter of a couple of weeks. Here's what the pricing looks like on the median price in Stanislaus County. You saw the peak price here at $485,000. We are up 7.1% in 2023. As you could see, we ended 2022 at 420 median price. We saw a price decline in January, and then we saw recover as the rates came down and buyers stepped back into the market. Again, recovering some of that, and we're currently at 7.1% price increases. We're still down 4.3% in the last 12 months. If you look at the 12 average, down 7.2 from the peak, and down 2.3 from 2021. Again, for a recession, for a pullback in pricing, you have not seen a balloon in inventory. You have not seen a complete collapse in pricing. You have seen an affordability destruction with the term really over the price. And then San Joaquin County looks very similar. So they saw 3 months of increases. They're up 7% in 2023. They're up 3.2% month over month, and they're down 8.45% from the peak, which was in May of 2022, peaking at $568,000 median price. Today we're at $520,000 in median price. So again, this is what that looks like with the nominal prices nationally. So you could see the run up in prices. This is the collapse of where 05 and 06, 07 and 08. You saw the run up in prices here. It's kind of what we saw during COVID, and a slight pullback here. So this is kind of where we're at. So again, you're seeing that that's an 8% drop in pricing. A lot of that, again, due to the term. So the months of inventory absorption rate. If we don't put another property up for sale, how soon will the inventory be gone? Again, dropping down 1.3 months of inventory in Stanislaus County. We were looking to see if it's going to break this high, which was 2.7. San Joaquin County was at 3.2 months of inventory. We're sitting at 1.2. Again, just incredibly low amount of inventory. And the traditional market is 4 to 6 months. So right now, the market is still moving. You're starting to see some of the pressure ease on some of the pricing of the monthly mortgage obligation for the buyer as the rate continues to come down. We'll continue to monitor it. It's a super interesting market right now. It's very hard to navigate as we're working with sellers and buyers. We feel a lot for the buyers right now because even though they're getting prices of houses 8% lower, their payment is 20% higher. So it's definitely hard for the sellers that are getting 8% less. It's hard for the buyers that are still paying more on a monthly obligation, and it's still affecting the real estate industry when it comes down to the transaction counts. But this is the time where you get strategic with negotiating some credits, some rate buy downs to be able to save up to 100. Sometimes 150,000 over a 30-year period if you get the right term. They do say something like, date the rate, marry the property, which I would caution you on, because if you do date the rate and you're hoping to refinance in the future, there could be likelihood that you might not have a refinance opportunity if prices do come down another 5%, or if they stay flat and you don't have the equity to be able to refinance. You might be stuck with that rate a bit more. So it's important for you to be very, very safe when it comes down to buying within your means. We understand there's a lot of pressure there with the rental market. So we are here to help. If there's anything you need, any questions you might have, reach out to us. We are going to have a Catching Falling Knives seminar that we did last year, just touching on the market again. If you want to register for that, let us know. If you want a free valuation on your property, click on the link above, and our website will generate one for you. If you have any questions, reach out to somebody on the Del Rio group. And if you're in the market to buy a home, happy house hunting, have a lot of patience, and remember, measure twice, cut once. Until next time, see ya.